India is witnessing the largest ever attempt to foster widespread participation in capitalism. As the Indian stock market surges, millions of households are seizing the opportunity to become stakeholders. With entry barriers falling, nearly 100 million people living close to the poverty line have now joined the ranks of capitalists by owning small shares in public companies. Today, 1 in 5 Indian households hold stocks, a significant rise from 1 in 14 just 5 years ago. This rapid growth in participation marks a notable shift in financial accessibility and the democratization of wealth creation in India. This number is expected to rise further. India's financial regulator plans to launch a new mutual fund with a minimum monthly contribution of just 250 rupees, $3, catering to low-income households. Those who invested early have benefited from remarkable gains. Over the past 5 years, Indian stocks have increased by 80% in dollar terms, compared to only a 6% rise across emerging markets. This dramatic growth reflects both optimism and expanding economic potential in India. However, this success also brings heightened risks. Many investors, new to financial markets, lack experience and may not fully understand the potential pitfalls. The euphoric market sentiment has driven up stock prices to levels far above their earnings, making them appear quite expensive. Additionally, financial liberalization has spurred rapid growth in derivatives markets, raising concerns about stability and exposing inexperienced investors to complex financial products. The 250 rupee fund exemplifies India's financial evolution. It is sponsored by Aditya Birla Sun Life, a joint venture between an Indian conglomerate, Aditya Birla, and a Canadian insurance firm, Sun Life. This partnership also symbolizes the resurgence of foreign firms in India's financial sector. Sun Life's history in India dates back to the 19th century, though it was forced to exit in 1956 when the government nationalized insurance companies as part of a socialist push. Remnants of Sun Life's past are still visible in Mumbai's old business district, where a rusted sun logo adorns a crumbling entryway. Sun Life's return just before the millennium and its growth plans reflect changes in India's political and economic landscape. Financial liberalization began in the early 1990s, but its benefits did not initially reach the broader population. Over a decade ago, cash and bank deposits accounted for 2/3 of household assets. Since then, regulatory and technological advancements have made investment accounts far more accessible and affordable. Previously, opening accounts required extensive documentation, while broker fees and the risks of handling physical share certificates posed significant obstacles to less affluent investors. The digitization of India's financial infrastructure has driven this change. In 2016, India launched its Unified Payments Interface, UPI, a system for electronic transactions that has since become widely adopted. UPI links users to bank accounts, fulfilling identification requirements and enabling quick withdrawals for stock purchases. This digital shift has also enabled dematerialization, or the conversion of physical share certificates into digital records. As investment habits evolve, the portion of household wealth held in bank deposits has declined to below half, and, if trends continue, is projected to fall to 1/3 by 2030. A campaign backed by the Mutual Funds Association promotes the slogan, "Mutual funds are the right choice," leading to a surge in popularity. In August, the number of mutual fund accounts reached 205 million, up from 73 million in 2021. These accounts, while often small, averaging under $4,000, represent a significant expansion in household financial engagement. This growth has been fueled by a wave of digital brokers. Grow, for instance, aims to simplify investing, while Zerodha encourages diversification with its tagline, "Invest in everything." Much of this growth is driven by products accessible to smaller investors. Systematic investment plans, SIPs, a tool for regular mutual fund contributions, have grown from 10 million to 99 million in the past 8 years, with contributions reaching $24 billion in 2023. In August, these funds received a record $2.8 billion, marking a trend of sustained monthly inflows dating back to 2016. Additionally, DMAT accounts, which store shares in digital form, have surged to 171 million as of August, a 54% increase since January of last year. The most extreme trend, however, is in derivatives trading. India now accounts for 80% of global trading volume, with retail investors representing 40% of trades, up from just 2% in 2018. A wave of initial public offerings, IPOs, has also fueled enthusiasm. India accounted for 30% of global IPOs by number in the first 3 quarters of this year, with a notable example being Zomato, a delivery company that went public in 2021 and now trades at a price-to-earnings ratio of 291, typical for fast-growing tech firms. Signs of market frenzy are also evident in other areas. A recent IPO by Resourceful Automobile, which operates Yamaha dealerships in Delhi, was oversubscribed 419 times. Additionally, a report from India's finance ministry highlights widespread misselling in banking and insurance, indicating it is too rampant to be dismissed as an aberration. On social media, influencers tout quick, unrealistic gains, while data from India's financial regulator shows that over 90% of individual traders in futures and options suffer losses. Opposing these retail investors are major quantitative trading firms. Jane Street, a leading firm, is currently in a legal dispute with former employees and their new employer, Millennium Management, over the alleged replication of a highly profitable Indian options strategy. According to legal disclosures, this strategy earned Jane Street $1 billion last year, a significant share of its overall profits. Regulators in India are increasingly concerned. In October, they introduced new rules for derivatives, including larger minimum contract sizes and stricter margin requirements to protect against significant losses in certain short-term options. After a prolonged period of market growth, new investors may be especially vulnerable to disappointment. Most Indian retail investors have yet to experience a market downturn, and a correction would likely be unsettling. The price-to-earnings ratio for major Indian stocks based on expected earnings currently sits at 23, well above the emerging market average of 12, highlighting stretched valuations. Recent IPOs reflect some caution, as seen in Hyundai Motor India's October IPO, which raised $3.3 billion but now trades around 7% below its issue price. The Sensex index has also declined over 7% since hitting an all-time high in September, a minor drop but a concern given current valuations. There are further signs that experienced investors are withdrawing. Data from Pace360, a wealth management firm, reveals that promoters, key corporate shareholders, have been net sellers, offloading nearly $1 billion of stock each month through the secondary market over the last 15 months, an increase over previous years. In October, foreign investors recorded net sales of $11 billion, marking the highest monthly outflow on record. While India's vibrant and increasingly inclusive capital market is worth celebrating, a possible bubble could serve as a stark lesson on valuations, potentially at the expense of the newly engaged small investors. Please leave a comment, like, and subscribe to the channel. You can also support us on Patreon, link below.